Let's talk some big tech as we've been focused on some of the movers this morning. Russell up big. Our focus shifts to earnings. Netflix is coming this afternoon. Michael Pachter joins us from Wedbush Securities, Managing Director of Equity Research, covering the streaming giant. Mike, good to see you again. What's the baseline for Netflix this afternoon? What are you looking for?
I think really all that people care about is subscriber growth. And I think what we're not going to hear about, but I think we're going to have to do a little work and figure out is whether they're approaching parity between full price, no ad subscriptions and ad supported discounted subscriptions, because that's really been the growth driver. And they've grown ad supported subscribers by more than twice their total number of net subscriber additions. That tells you people are switching, and that's really good. I think that Netflix offering a lower priced option for consumers who are willing to watch ads keeps them from ever declining, keeps churn in check. And the key is, are they getting the ad rates that they hope to? I think the answer to all of that is yes. And I think we're going to come out of this earnings call feeling a lot better about the stock. So I expect it to continue its upward trajectory.
Where are those lower tier customers coming from? Are they switching or are they adding on to existing streaming services that they have, Mike?
Well, a lot of the growth initially, came from the password sharing crackdown, and obviously they've offered people a chance. People like me with grown children who happen to live in my home, but I can add each of them for $7.99 a month ad free. But when they move out, I can keep them at that, or they can subscribe on their own. I think it's really the latter. It's people that are either normally would churn out, that are Netflix subscribers for 6 months at a time, or and then churn out and come back. They're not churning out. They're continuing to become a subscriber. They're just trading down. So I frankly think that growth is virtually unlimited. They're making it cheap enough that at $6.99, Netflix is your least expensive streaming alternative, as opposed to $15.49 where they're your most expensive. So all the other guys are between $9.99 and $13.99. Netflix has managed to kind of get in there cheaper. I'm paying $9.99 for Hulu with ads. So I'm only $6.99 for Netflix with ads is a bargain.
How about the stock in terms of valuations? Has all of this helped ease off some of the concerns around the stock price and valuation at all, with more paid and more profit?
Well, up here, in the mid 800s, it's trading at 35 times out year earnings. So it's not cheap by any means. But as they kind of approach 300 million paid subscribers, you start thinking about ways they can extract an extra dollar per month per subscriber. Most of that's going to be from ads, and they don't have to really increase the ad load very much. They just have to prove that their ad delivery is relevant, and they'll get higher CPMs on the ad rates. But if they can raise price by $1, that's about $8 a share in net income growth. So it's really easy to see over the next 3 or 4 or 5 years, prices going up by $2 or $3 per subscriber, which is again not that much in the context of pretty high inflation for everything else. And you're going to start seeing these guys making $40-$50 a share instead of 30, which is where most analysts are.
Wow. How about the live stuff? What's on the calendar for this coming quarter? When that has been such a big effort from them, do they need to put that type of stuff in the outlook, or do they just drop it along as teases when their programming gets closer to fruition? How does that kind of work as a catalyst for the shareholder base and for expectations around earnings?
As much as I admire their efforts in live, I think it's actually kind of a stupid idea. And
really,
you're just not going to you're not going to make money with football games. And you're paying $150 million to broadcast a football game, on Christmas Day. So one day a year, people are going to join to watch football, but that's just not that big a deal. The WWE live effort, I think, is actually pretty smart, because even though they only had 600,000 viewers that first day, over time I think they're going to win over an audience. I consider that similar to Howard Stern on Sirius XM about 18, 20 years ago. It drew a lot of subscribers over time because people really like that content. So give the WWE some time to materialize. And I think the beauty of that deal is that it's entertainment as opposed to, an actual sports outcome where we were on the edge of our seat like last night. So I actually think being able to archive that content means you're going to attract and retain subscribers. And that content's pretty much year round. So I really like the WWE deal. I really, really don't like live sports. I think that's too expensive. They're playing in an arena where they can't compete with Amazon or Google, the guys who are going to try to buy that for YouTube TV with Sunday Ticket or buy it for Amazon Prime. They can never compete with those two guys. I would get out of the way and leave live sports to the big boys.
All right. Mike, thanks for the analysis. Interesting. Appreciate it. All right, let's do some trading. George Tillis. Got two ideas. Got a neutral and we got a bullish one. George, let's start with the neutral one as we're into earnings, $859. Some reservation about the live event spending and strategy. What do you got, GT?
Well, if we're going to go neutral, we're basically going to look at what's happening with the earnings event. The implied volatilities and the options are quite robust. The market maker move expectations around $70. But if you go into, of course, we have a shortened week. In the next week, the implied volatility is still relatively robust for all the options in the chain. So what I'm going to do is I'm going to structure an iron condor, which is a neutral trade, but I'm not going to choose this week's expiry. I'm going to give some flexibility into next week, expiry on January 34th. So I'm going to essentially, 31st, I'm going to essentially sell the 950, 960 call spread that's above the current price, and then below the current price, I'm going to sell the 790, 780 put spread. So altogether, you could structure this trade for about $4 in credit or $400 a contract given to you or provided to you if you structure this trade. So in essence, we want to see the stock price stay well contained within the short strike boundary, and that's 950 high and of course 790 low. And ideally, your return is $4, your risk is $6, and that's if we have a higher probability event past the market maker move, which is a 1 sigma event. Your max loss is $6, and that occurs if you have the price action move above 960 on the high side or 780 on the low side.
Okay. All right. Fair enough. So $4, $400, kind of to bet in the range. Not terrible at all. How about if you want to get long, George, if you think they're going to blow the doors off in their last display of subscriber growth?
Yeah, so if you're looking at a bullish trade, obviously just buying options straight out or call options is expensive. So there's a lot of ways you can do this. One way to structure a long call position going out to the February expiration in 31 days, I'm going to sell basically a very narrow short-term option that has a high implied volatility. So I'm going to sell in this case the January weekly that expires in 3 days, the 915 call option. And then I'm going to use the proceeds of that because it's expensive with a high implied volatility to purchase an in the money or slightly out of the money 865 February monthly call option. So altogether, this would cost you about $26 a share, $2,600 a contract. So in essence, it's a bullish trade. You participate, obviously, the stock goes higher. If you do essentially hold this to expiration, this is again looking at the February contract, your break even is $891. You have to be mindful of that. But if we do have a sort of a blowout move above your short strike in 3 days, 915, you just don't get to participate past that level. And so that's something to keep in mind. But ideally, again, it's a way to structure a bullish trade that allows you to pay less for the February in the money call options. And again, these call options have a much lower implied volatility than the one you're selling, which expires in 3 days.
All right. So looking for upside that does get capped out, selling some against the position to hedge it out like that, give you some buffer, some breathing room by selling the 915. And you only need $6 to roughly to get in the money for the 865 call, 31 days to do it. You're not asking too much from Netflix there. Seems reasonable. Thank you, George. Bullish trade, neutral trade. Appreciate GT. Thanks, Mike Pachter, for the prep on the earnings.